80% of the time, stock goes nowhere in a range, and most traders lose money trying to pick a direction. But there's a strategy that turns this range into income, collecting premiums from both sides simultaneously. I have placed hundreds of these trades since 2018 with a 90% win rate. Today, I'll show you the full system I use to trade my 7-figure portfolio. The short strangle strategy. This is a strategy that I always have a few on in my portfolio at a time because I love this strategy so much. So let's go into what are short strangles now. A short strangle is simply combining an out-of-the-money call and an out-of-the-money put simultaneously on the same underlying with the same expiration. The result is a wide profitable zone centered around the current stock price. In other words, this is a short naked put plus a short naked call, and that's how you make a short strangle. So you have a naked put on one side, a naked call on the other side, and you're kind of like strangling the stock that's in the middle. That's the analogy. Let's talk about why this strategy works and its benefits first of all. The short strangle is built around a simple but a powerful edge. We use time decay in our favor. Every day that passes, our position becomes more valuable, regardless of what the market does. The first thing I really like about this strategy is you're able to receive immediate premium income. We collect cash upfront the moment we enter the trade. There's no waiting. Income starts on day one. And once you collect this cash in your account, you're able to even withdraw it. You can transfer it to another account. You can use it to buy some stocks. You can do whatever you want with it. It is cash in your account immediately. The second benefit of this strategy is it's double the premium income because you're selling two legs, a call and a put, which is about double the income compared to selling a single option alone. So if you compare this with just short puts, this is almost 2 times the short put income for the same amount of capital usage. I love this trade also because it is direction neutral. There's no need to guess where the stock goes. As Al Brooks says, 80% of the time, market simply ranges. And this is exactly where this strategy thrives. Last but not least, this is a very high win rate strategy. It is about 90% when structured correctly. The high probability of profit makes this one of the most consistent strategy available to retail traders. So this is a very long video. It will be about an hour long. The course is organized into 3 modules. Each builds on the last, taking you from the foundational concepts to live trade management. So it is important for you guys to save this video if you can't watch it all at once and watch it in order. I have broken this video up into chapters so you can come back to it anytime and start where you left off at. The first module that we're going to be focusing on is the foundation of this strategy. We're going to introduce you to this strategy. We will talk about the options and the Greeks of the short strangle strategy, and also how to enter short strangles step by step. In the second module, we'll talk about the setup of the strategy, how to choose the right underlying stock, the ideal strike price, and the best time to expiration. This module will teach us how to choose the best option contracts and the best practices around it. The third module will be about trade management, understanding the returns via return on margin, managing risk, knowing when to take profits, and how to roll positions when the position goes against you or when time expires. So to begin, we have to go through the foundations and talk about what are options. This may be a refresher for you guys. If it is, you can skip to the next chapter. Options are financial contracts that grants the buyer the right, but not the obligation, to buy for calls or sell for puts, an underlying asset at a predetermined price, also called the strike price, before a set expiration date in exchange for a fee called a premium. So buying options are not free. You have to pay a premium to buy it. Buyers pay a premium for the leverage and directional bets. This is a losing strategy long term. In Reddit's WallStreetBets subforum, they use the word lotto ticket a lot. Most of these lotto tickets, these long options, expire worthless. And this is not what we do. We sell options. Seller collects the premium upfront and let time do its work. The seller has an obligation if assigned, but with the proper strike selection, assignment is very rare. In our strategy, we will be selling put and call options at the same time. This is a two-leg strategy. Let's go over what that means. When we sell an option, you flip the dynamic entirely. Instead of paying a premium like option buyers, we are collecting the premiums. And the goal is to simply let time erode that premium to zero. So when we sell a put, we're going to receive a premium and take on the obligation to buy the underlying at the strike price if the buyer exercises. This only happens if the underlying expires below the strike. Think of it as being paid to be willing to own a stock at a lower price. Now on the other side, the call side, the upside, you are receiving a premium to take on the obligation to sell the underlying at the strike price if assigned. You profit as long as the stock stays below your call strike. So if we use the insurance analogy to explain this, you are the insurance company. You collect monthly premiums from the buyers seeking protection, and most policies never pay out, and you keep the cash. It's like buying home insurance. You pay a premium every month to the insurance company in case your house gets burned down, and they will help you rebuild the house full cost for free. Now, most of the time, as you know, we pay the premium and our house never burns down and the insurance keeps all of the premiums that we made. This is the exact same scenario for option selling. The key with option selling is pricing risk correctly and managing the large moves if something goes wrong. As long as we manage our risk properly, we will be profitable. This will make a little bit more sense when I show you the P&L chart. The payoff diagram tells the whole story. You collect a fixed premium upfront. That's your max profit. The trade is profitable as long as the stock stays between your two break-even points. So let's take a look at this payoff P&L chart. When you open this trade, you're going to be selling a 95 put and also a 105 call. These are both naked options, short options. The profit you collect is $500. Your max profit will always be the amount of premium you collected. You cannot make more than that. As long as the stock stays between your put and call strike in the middle, you will make max profit at expiration. Now the break-even points will be your short put side minus the premium that you collected. So 95 minus $5, the break-even point will be $90. On the top side, your break-even point will be your call option plus the maximum profit of $5. So 105 plus $5 will be 110. As long as you stay between 90 and 110, you will make money. The max loss of this trade is the top side when it blows past your call side. That is the danger. Theoretically, there's unlimited risk on the call side. And on the downside, on the put side, it is a defined risk trade because the stock can only go to zero. In any case, we will have active management strategies to manage this trade. And it is essential because we cannot allow us to go to unlimited loss. Also, I want to point out unlimited loss is just theoretical because in reality, nothing goes to infinity. Let me show you how to open a short strangle. I have QQQ open here, and the first thing I'm going to be looking for is the 45 to 60 day option contracts. I see a 45 days right here, but it is weekly, and I like to avoid weekly options. So I'm going to choose the next one, which is 63 days. This is the monthly options, and I prefer that much more. I'm going to open that up. I'm going to look for the 20 delta on the put side, which is on the right. Right here, 630 is 20 delta. And I'm going to look for the 20 delta on the call side, which is on the left. Scroll down. Right here, 755. So I'm selling that. Make sure it's red, and in Tasty Trade, it should say S and it's red. Same goes on the other side. You will notice that you're going to be collecting a credit of 1687. So you have to multiply that by 100. So that's going to give you $1,687 when you open the short strangle. That is almost 2% of the current at the money price. So that's it. It's that simple. That's how you open a short strangle. If we look at the curve, P&L curve, this is how it looks like. As long as we stay between our strikes of 630 and 755 at expiration, we're going to make a max profit of 1687 on expiry. Our break-even points will be 630 minus 16.87 right here. And on the top side, our break-even points would be 755 plus the credit we receive, which is 1687, which is approximately here. As you can see, the range is quite big, and all we need to do is the stock to be landing in between this green zone on expiry to make max profit. This is a very high probability trade. As you can see, P50 here, probability of hitting 50% profit target is 85. When the market was trading, it was near 89%. This is aftermarket data, so it's incorrect. It's not 85%. It's higher than that. So that's how you trade a short strangle. The next thing I'm going to be talking about is the option Greeks. The option Greeks measure how an option's price responds to change in the market. For short strangles, there are three major option Greeks that define our entire edge, and that is very important in this trade. Understanding them is non-negotiable. The first one is delta. Short strangles are delta neutral by nature. Delta measures the directional exposure. We target near zero delta, which means we have no bullish or bearish bias. The trade profits regardless of direction, as long as the stock stays within the range. So we want our deltas to be always near zero if possible. That's how we make the most stable amount of money in this trade. Vega. This is a Vega negative trade. Vega measures the sensitivity to implied volatility, also called IV. We are short Vega, meaning we profit when the IV drops after we enter it. So that's why we enter when the IV is elevated, when IVR is above 30 for maximum edge. Also, when the IV is high, we get to open the put and call strikes wider than average. Because when volatility expands, the same strikes compared to when the volatility is low is always far larger, making the range a lot bigger than when the IV is lower. The third option Greek that works in our favor is Theta. This is a Theta positive trade. Theta is our engine. Every single day, the premium on our short options decays in our favor. We are paid simply for waiting, and this is the core of the passive income approach. Now let's talk about Theta decay, because this is your daily paycheck, and this is the main option Greek that is making us money, so it's worthwhile to understand it properly. Here's a chart of Theta decay, and as you can see, this is not a linear chart. This is an exponential chart. Theta is the rate at which an option loses its extrinsic time value, also called premium, as it approaches its expiration date. Every single day, option bleeds value. And as the seller, that erosion is our profit. If you look at this chart, we can see that the decay is slow in the early weeks. From 90 to 60 days, it's fairly flat. The decay accelerates meaningfully after the 60-day mark. You can see right here, the curve is steeper now. Decay is the most rapid in the final 30 days. It's extremely curved, you can see here. Theta works 7 days a week, including the weekends. So we aim to position ourselves right at the start of the acceleration curve, which is approximately 60 days. Decay accelerates sharply within the last 30 days, so we like to target the 45 to 60 days window to capture the steepest portion of the theta curve while avoiding excessive gamma risk near expiration. By the way, if you like what you're learning so far, check out the link below in the description to download your options for income playbook. Now back to the lesson. How Theta puts money in your pocket. I'm going to give you a full concrete example of how Theta is working for you every single day, whether the stock moves or not, and while you're sleeping. So the stock is trading at $100. We're going to sell a strangle around this $100 stock. So we're going to go 20 strikes below 100 and 20 strikes above 100. So we're going to sell the 80 put and also sell the 120 call with 30 days to expiry. We're going to collect about $200 in premium, and the theta decay will be about $6 a day. So 10 days passes. The short put and call has lost $60 in extrinsic value due to theta alone. Why? Because each day we lose $6, and in 10 days that's about $60. Even if the stock hasn't moved. That's $60 of profit locked from time decay. So what can we do about it? We can close the trade. We can buy back the short put and call for $140 less than you sold it. Choosing a good underlying. Not every stock or ETF is suitable for short strangles. The ideal underlying is liquid, range-bound, and has elevated implied volatility. Here are a few things I look for. The first thing is I only look for large cap stocks, big names like Nvidia, Netflix, or Meta. These stocks have high option volume, which means tight bid-ask spreads and reliable fills. I also really like sector ETFs. Some examples are XLF Financials, XLU Utilities, EEM Emerging Markets. These are great for diversification and consistent data. Futures. These are for larger accounts, but if you have access to them, they're excellent. You can trade the gold futures, the oil, the bond, the currency futures. All of them have excellent liquidity and have often very favorable margin treatments. Last but not least, one of the most important things is to have a high IV. When the IV rank is above 30 plus, it means the IV is elevated and premiums are good. I have Tasty Trade open here, and I want to show you guys how to check the liquidity of an instrument and also how to check the IVR of an instrument. First thing, if you go to your watch list, the gear button, you will have the ability to add the indicator called liquidity rating. And also you can check the IV rank percentage. Add both of that to your watch list. Now, liquidity, let's talk about liquidity first. Our goal is to sell options on highly liquid instruments. In Tasty Trade, if something has 4 out of 4 stars, it means it's highly liquid. I would personally not sell options on any instrument that has anything under 3 out of 4 stars. So 3 out of 4 star like XLP is all right, it's reasonable. XLE right here has 4 out of 4 stars, so I like that. Now, if you look at something like IYR, it only has 2 stars out of 4, so I would skip that entirely. Also, to look for the highest option interest options, I only trade the monthly options. You can tell which are the monthly options by simply looking at your option chain. If there's no W on it, then it means it is monthly. All these options with a W on it are the weekly options, and generally the option interest and bid-ask spreads are fairly bad. Monthly always has the highest option volume. Another thing to look out for is to trade round numbers. You can see right here, this monthly options for August 21st, the round numbers have a lot more open interest. You can see 690 has 40K option interest, whereas 691 has 0 option interest. So when you trade options, you want to trade round nice numbers like 690, 695. You can see there are a lot of option interest on those. And because of that, you can tell the option bid-ask spread is also much nicer and you'll get filled easier. The next thing I want to talk about is the IVR, the IV rank. Once you add the indicator to your watch list, you should be looking for IVR that is above 30 if you want to sell Strangles on. It's also indicated up here. That's one place to find it. Another place is on your watch list. Now, today QQQ is fairly volatile and its IV rank is 77. So that's a very good candidate premium wise to sell options on. XLE is also very nice to sell options on because the IVR is 72. Anything above 30 is reasonable. And if it's below 30, I would avoid selling options on it entirely. The next thing I want to talk about is technical analysis, how to spot a range and confirm the range. Before entering a strangle, we have to confirm the underlying is truly ranging and not trending. Again, this strategy is not for a trending market. It is used for when the market is consolidating or ranging, which is 80% of the time. I personally use these 4 technical signals together for the highest confidence setup. You can add your own various technical analysis on top of these 4 signals for even higher confirmation. I'll just show you what I personally look for. First thing I look for is RSI near 50. A relative strength index reading near 50, the midpoint, confirms the stock has no strong momentum in either direction. This is ideal range condition. The second thing I want to be able to do is the ability to draw a box around the past 1 to 3 months of price action of daily candles. If the price is bouncing between a clear support and resistance zone, the strangle has a natural profit zone. I'll show you a few live examples in a little bit. Parabolic SAR. This indicator, I'm looking for the SAR dots to alternate above and below the price, like a sine wave, indicating oscillating and non-directional price behavior. I also use the 9, 21, and 50 EMA. When the short, medium, and long-term EMAs are compressed or stacked or tangled together, rather than fanning out, the stock is ranging and consolidating. That's a green light to trade. If they're fanning out in one direction like this, then it means it's usually trending and it's not the time to sell strangles. When to trade strangles? Let me show you a few chart examples. This chart illustrates a textbook strangle setup. Price is oscillating within a well-defined range. EMAs are compressed together, so you can see the yellow and the teal and the purple line. They're fairly flat, and the 9 and 21 EMA, which is the yellow and teal, is compressed together. RSI is around 50. It's right in the middle. Also, the parabolic SAR, these are the gray dots right here. it is oscillating up and down like a sine wave. So you can see this is going down, it's going up, it's going down again, and it's going up. The price action is right in the middle of a box that I can easily draw around this whole price action. The top of the range and the bottom of the range is pretty clear. This is a textbook example of the perfect time to sell a short strangle on. Here is another example of a good range candidate. Notice the EMAs, the yellow, purple, and teal line is stacked together. I have a box drawn around the last few months of price action of daily candles, and you can easily draw a box around it. The parabolic SAR dots is going down, up, down, up. The price action is currently right in the middle of the range right now. RSI, it's near 50, it's above 55 in this case. So this is a good candidate. Let's look at another example. Here we have another range. The EMAs are pretty stacked together. Right now the price action is somewhat in the middle of the range. You can draw the support and resistance zone fairly easily. You can view them very easily with a purple box around it. RSI is approximately 50. It's almost 50. I think it's about 45 right here. The parabolic SAR dots, the gray dots, are going down, up, down, up, down, up. It's very nice. And it has been ranging for the past 3 months. Another textbook example right here. RSI is at 60, which is not too bad. It's still reasonable. It is very easy to draw a box around the support and resistance zones. The EMAs are pretty stacked together, the yellow line and teal line. It has been ranging since July all the way to mid-September. So it did not trend for the past 2.5 months. So that's very nice. This is another candidate for a short strangle. Another one right here. Since June all the way to September, it has been in a range. It did not go anywhere. It's pretty sideways. The EMAs are pretty stacked. RSI is near 50. It's at 60 at the moment. That's not too bad. The parabolic gray dots right here is going up and down like a sine wave. This is a good candidate. Choosing a good expiration. Expiration selection is one of the highest leverage decisions in strangle trading. Too short, gamma risk rises. Too long, the theta decay is too slow to be meaningful. So let me go over some best practices. The best time to sell short strangle is between the 30 to 60 day range. This is the sweet spot for premium selling because theta accelerates meaningfully and there's enough time to manage the trade without panic. I personally like to trade the 45 to 60 days. Personal preference here, okay? In my opinion, this is the highest theta to risk ratio because this gives 3 to 5 weeks of cushion before the 21 days management triggers. I will be talking about this 21 days case in a little bit. Again, for liquidity reasons, we need to be trading monthly expirations only because they carry the highest open interest and the tightest bid-ask spreads. Weekly options are less liquid and harder to fill at good prices. I would ignore weekly options at all costs. Last but not least, this is one of the most important things. You have to avoid earnings. Never let your expiration cross an earning announcement. IV spikes unpredictably around earnings and the risk to reward becomes unfavorable for option strangle sellers. Let me go over how you can check the earnings date and how to avoid them. So I have NVIDIA open over here. If you see this purple line, it says E on it. That's the earning date, August 26th. What I mean by not crossing earnings when we open option trades is We should not be opening the September 1863 days options, because if we open something that is after the earnings date, and that's called crossing earnings. If you really want to open a trade for this stock, then you have to do it before the purple line, which is the 35 monthly options, which is perfectly valid too, because it is within our 30 to 60 DTE range. Why do we not trade earnings? The reason is because earnings are very volatile binary events. It can cause a stock to go up or down unpredictably. Whether the earning report is good or bad, it does not matter. There's almost always a gap after an earnings. And as a strangle trader, we want our stock to be staying in the same price and not going up or down too much. That's why we avoid it. Let me show you a few examples of what happens during earnings. I have Uber open here, and we're just gonna go through a few examples of what happens during earnings. Look at this earning event. It jumped up all the way there. That is not good for short strangles or range trading. Another example is right here, earning events. It dropped like crazy. Another earning events right here. It was good earning report, but yet it dropped like crazy. If we looked at, that's almost a 5.3, actually, it's almost a 10% drop from the highest highs to the lowest lows in one day. We cannot allow that to happen to our short strangles, which we don't want the stock to move. I'll pick another random stock like PayPal. Right here, earnings right here dropped over 12% in one day. That would have killed our short strangle trade. Another one right here. The stock dropped 20% after earnings. I think you guys get the point already that we should never cross earnings. And the reasons are very obvious. It's because of gapping up and down and big moves in the stock market. Let's talk about choosing the best option contracts. Strike selection. Strike selection defines your break-even points and your probability of profit. The goal is to sell strikes far enough out of the money to have a high win rate while still collecting a meaningful premium. These are just some guidelines to choose your strikes based on deltas. For stocks and ETFs, I would recommend beginners to sell the short call and the short put around the 15 to 20 delta. And that will give us approximately an 80% of the options to expire out of the money. Now combined, the probability of profit of taking profits at 50% will be near 90% if you sell 15 delta strangles. Now for futures, these are applicable for larger accounts. I personally like to sell 6 to 7 delta, and these are extremely wide strikes. Very high probability of winning. We're talking about 95%. It is suitable for experienced traders managing a larger margin. If you have access to them, I invite you to give it a try and take a look at the probability of profits. You don't always have to sell 20-20 delta strangles or 15-15. You can try 20 delta on the put side and also 15 delta on the top side, on the call side, to account for directional bias. You can have a little directional bias for these trades also. So for example, if the RSI is not exactly at 50, maybe it's at 60 or 40, and you're saying, okay, that gives me some reason to believe that it is slightly bullish or slightly bearish, then you can skew your strangle a little bit by selling. For example, if you are bullish, you can go 20 deltas on the puts and 15 deltas on the call to be slightly bullish. Or if you're slightly bearish, then you can go maybe 15 delta on the put side and 20 deltas on the call side to be a little bit bearish. It's up to you. Or you can just keep it simple, go 20-20, 15-15 for a balanced zero delta trade. Another very important rule of thumb that I want to introduce to you traders is for every 30 days to expiration trade, the total premium collected should exceed at least a minimum of 1.5% of the at the money strike price. This ensures the trade is worth the margin capital deployed. Let me give you an example. If the stock is trading at $100, then we should be collecting at least $1.50 in premium per share. So it's going to be 100 shares, so that's going to be equivalent to $150 per contract. This is for every 30 days. Below this threshold, the return on the margin may not justify the risk. So if this is a 60 days to expiration trade, then you should be collecting at least $300. This is just a rule of thumb. You can always collect more than that. So I'm going to show you an example of how to make a skewed strangle. Now, this is NVIDIA. Imagine you have a thesis that it is ranging, but it is slightly bullish. So what you can do is, for example, right here on the put side, you can choose a little bit higher delta. So let's go for the 23 delta right here. And on the call side, since we believe it is bullish and we don't want it to hit our call strike as quick, then we're going to sell maybe 15 delta, a 15 delta call. So the closest one is 16 deltas right here. So you'll notice it is a little bit unbalanced. The put side is a bit closer to at the money right now, and the call side is further away. It is almost 10 points more than the put side. If you look at the delta right here, it's not 0. It's about 6 delta. So for every point that it moves up, you're going to be making $6. It's still fairly small, this delta, hence it's still a strangle, but it is a slightly bullish strangle. So this is how you can skew your put and call deltas to create a bullish trade. Vice versa, if you want to have a slightly bearish strangle, you can do this. You can do 27 delta on the call side and less delta on the put side. So it will look something like this. And you'll notice the delta is negative 13. So for every dollar NVIDIA goes down, you're going to make $13 more because it's delta negative right now. So this is a bearish strangle. Again, most strangles usually like to go balanced. So you can go 18 right here and 16 right here. You want the delta to be near 0 as much as possible if you believe it is going sideways. So this is a more normal strangle. It's delta neutral. The next thing we're going to be talking about is trade management. There are 4 cases. Managing your open positions is what separates consistent winners from gamblers. Every strangle trade falls into one of these 4 scenarios, and each has a clear rule-based response. The first case is us hitting our 50% profit target. This is the most common scenario because the win rate for these trades are extremely high. The second case is 21 days to expiry is reached. This is the second most common scenario. Third case is our stop loss scenario when we hit 200%. And the fourth case is when we have to roll the position. This can happen when we hit 21 days or when the deltas is out of whack, but yet it didn't hit our stop loss. Let's talk about the first and second case, taking profits, and the 21 days to expiration scenario. Case number 1. This is the most common and cleanest exit. Once you capture half the premium, we will close the trade and redeploy the capital in another trade. So let me give you an example. Imagine you collected $100 in premium. The trade has decayed enough and we're going to buy back the strangle for $50. So we pocket $50 of profit. Research shows that taking profit at 50% dramatically improves risk-adjusted returns over holding to expiration. By the way, this research is from Tasty Trade themselves, and they always recommend taking profits at 50%. Case number 2, the 21 days to expiration rule. Gamma risk increased sharply within the 21 days to expiration. Small moves in the underlying can cause large swings in the option price. That's why we have to always close the position whenever it hits 21 days to expiration, regardless of what the P&L is. It can be a small winner or a small loss. You can close the trade entirely, or you can immediately roll the contracts out to a further out in time option. So a new 45 to 60 DTE cycle. Avoid holding through the danger zone. By the way, traders, if you like what you're learning so far, check out the link in the description below to download your options for income playbook. Now back to the lesson. Case number 3 and 4, stop loss and rolling. This is a very important case, the stop loss case. If a trade moves hard against you, if it goes out of the boundaries of the range or close to the boundaries of the range, we need to cut the loss before it compounds. We close the entire strangle when the combined premium reaches 3 times of what you collected. Let me give you an example. Imagine you collected $100 when you opened the strangle. We will exit the position when it costs $300 to close. So if we close it at $300 minus the $100 we collected, we're going to accept a $200 loss. This will prevent one bad trade from wiping out multiple winners. At that point, when you hit 200% stop loss, it usually means the underlying is no longer ranging and it's approaching the boundaries of your range, and it's no longer a range and it's going to start trending. And it is highly likely that it will continue to trend as trend continues. So at that time, it is best practice to close out the trade and move on. Let's talk about rolling. Rolling extends your trade's time horizon, buying back the current short options, and then we sell a new call and put further out in time. When do we roll? We roll when we hit the 21 days to expiration mark. Whether we're losing or winning, it doesn't matter. One thing we need to do is we need to re-examine the chart and check that we're still in a range, because if it's not, then it's better to just close the trade. But if it is, and it's still in the range, and your thesis of the stock is still consolidating and still ranging is still intact, then you can also rebalance the deltas back to neutral, try and make it as close to zero as possible. Always collect a net credit when rolling. Never roll for a debit. You can choose the same strikes or adjust the strikes based on the new price action. So you can look at the chart and say, oh, it's a little bit bullish now, so I'm going to sell a skewed strangle instead of a delta neutral strangle now. Let me go through an example of how to roll. I have SPY open here, and imagine we have a short strangle that is 21 days left, 21 days to expiry right here. Our strangle is currently looking like this, the 740 and the 760 strike. It is 21 days left and we're still not at the 50% profit. So what we need to do now is, because we're running out of time, gamma risk is getting strong. So what we're going to be doing is buying back these options and selling the short and call options that's further out in time. Let me show you what I mean. So we're going to buy back these two options. It's green and it says B. That's how we buy it back. We are going to go to the next monthly options, which is about 30 days out, and we're going to sell those strikes, the same strikes. 30 days out, the next monthly is September 18, about 63 days. We're going to sell the exact same strikes, so 740, sell, and also 760, sell the call side. Now, look at this. When we do this maneuver, we are collecting 1549. So that's collecting $1,549 of credit, CR. We have to make sure that we are collecting credit when we do this maneuver. And what happens is you have just turned your 21 days left options, and now it has extended itself in time, and now it is 63 days. This puts us back into the safe zone of not being in the 21 days to expiry zone. Moving on, we're going to talk a little bit about how to calculate the return on margin and the returns of this short strangle strategy. Unlike stocks, you don't invest capital upfront. Returns are measured as a percentage of the margin required by your broker to hold the position. This is called return on margin. Let's do some math here. So say we sell a short strangle on Disney with the 90 put and the 105 call, and we're going to collect $3.11 in premium. The margin required to open this trade is only $1,382. If we divide 311 by $1,882, that is 22.5% of return in just 38 days. Now, if you calculate the annualized return on margin, it's going to blow your mind. Compounding the same trade structure across a full year yields is an eye-opening of $216 annualized return on margin. Now, you also have to remember most of these trades close faster than 38 days and we don't hold it till expiry. So it will probably hit our 50% profit target way before that. So how I came to the conclusion of 216% a year is simply by dividing 22.5% by 38 days and times 365. And the percentage is 216%. Actually, a little bit more than that. This example trade reached its profit target in 38 days. Closing it early and redeploying capital accelerates compounding even further. This 22.5 return in 38 days is a conservative number because our trade will probably close faster than that. ROM, return on margin, compounds when you reopen new trades after closing winners early. The faster you cycle through trades, the more you amplify your annual returns. This is the real power of this strategy. Risk management and position sizing. I think this portion of the course is the most important part of this whole lesson. Disciplined position sizing is the foundation of a sustainable option strategy. Follow these rules consistently and you'll never blow up your account, no matter what the market does. Even if all your position goes to stop loss, you will not blow up your account if you follow these rules. So pay attention closely. Max per position. Each position should be no larger than 5% of your net lick. On a 100K account, that means no more than 5K of margin per trade. Overtrading is the number one killer. This rule prevents it. The max number of positions open should be around 6 positions at a time, keeping total margin usage at or around or below 30% of net lick. So if you have a 100K account, then you should not be using more than 30K of margin. Leaving capital in reserve protects you from the drawdowns and unexpected moves. Credit target. Each trade must collect a credit equal to 1% of the net lick. On a 100K account, for example, you should be collecting at least $1,000 in premium per position. Stop loss rule. Exit any position if the loss reaches 200% of the credit collected. capping your max loss at 2% of net lick per trade. So on a 100,000 account, you're going to collect $1,000 of credit and stop out at $2,000. So the max loss is 2% a trade. That will never blow up your account. Following these rules in your account means your worst case would be just $2,000 per loss per trade on a $100,000 account, just 2% of your capital. Stay consistent and account blowups become mathematically impossible. Even if you have 6 positions and they all are losers, that's only 12% loss of your total account. And that is reasonable, that is controllable, and that is acceptable. And it will not destroy your account. Risk management. Another way to manage risk is diversification. Spreading positions across uncorrelated asset classes reduces the risk that any single market event wipes out multiple trades simultaneously. Target exposure across all 6 sectors below. The first sector that I love to trade is gold and metals. Gold moves independently of equities, providing a natural hedge against risk-off environments. There's also silver that you can trade along with gold. The reason why I chose gold as one of my other assets to trade is because the correlation between gold and the stock market, as in the SPY, is fairly low. I will tell you in a little bit how to check for low correlations. Oil and energy. Energy commodities offer low correlation to the equity markets and provide strong premium selling opportunities. The IV is generally fairly high on the oil and energy futures or sectors. Agriculture. This is like corn, this is wheat, hogs, or cattle. Grain and soft commodity futures respond to weather and seasonal cycles, entirely different drivers than the financial markets. Equities and index. Of course, we're going to have position in those. SPY and QQQ offers deep liquidity and tight spreads. Broad index exposure is the core of most option portfolios. Just keep in mind, if you have equities already, like SPY and QQQ positions, you don't want the rest of your positions to be all stocks because they move very similarly to the SPY and QQQ index. Bonds. Fixed income often moves inversely to the equities, making bond options a natural portfolio ballast during equity stress periods. It doesn't move the same way as the SPY and QQQ, so it's a very good candidate to sell Strangles on also. Last but not least, various sector ETFs. This is one of my favorites because these don't have earnings. You don't need to worry about earnings as ETFs never have earnings. A single stock earnings will not affect the ETF, the whole ETF too much because it's only one holding in a basket of stocks. XLF Financials, XLV Healthcare, XLU Utilities, and others give targeted exposure while keeping diversification. Let me show you how you can check the correlation to the SPY in Tasty Trade. Under the watch list, click the gear button and look for beta. What beta means is it is how much the instrument will move when SPY moves. So XLP is 0.49 beta. It means in general, when the SPY moves $1, XLP will move only 49 cents up or down. So the lower the number, the lower the beta correlation, the less likely it behaves like the SPY, which is good. So you want to have a bunch of positions that have very low beta correlation to the SPY and to each other to diversify. If you look at XLE, the energy sector ETF, the correlation is only 0.47. I like that a lot, so I would be looking to do a strangle on that. You can look at XLV. This is the healthcare sector. You can see the correlation is also very low. XLU is very low. Now XLB is quite high. You can see 0.94. That's almost 1. So I probably will skip this ETF. TLT are bonds. You can see it's only 0.52. So that's another good candidate. USO, that's oil, 0.04. So that's very low correlation. That's another very good candidate. Key risk considerations, some other stuff to consider. Beyond sizing and diversification, these operational principles protects capital and keep you in the game for the long run. Avoid high volatility stocks. As a credit seller, you want the underlying to move as little as possible. Stick to liquid, low volatility underlyings. Large ETFs are a good choice. Commodity futures are also good, and major indexes such as SPY or QQQ or IWM. Wild movers destroy premium selling strategies by breaching strikes before expiration. So no IPOs, no WallStreetBets style stocks, please. You want large, stable, boring companies. You can always exit early. Options are not a set and forget instruments. Like stocks, you can always buy back the option anytime the market is open, closing your position and capping your loss immediately. Never feel trapped in a trade that has gone against you. Futures options. One benefit of future is there's after hours flexibility. Future options trade nearly 24 hours a day, giving you the ability to exit position after hours, even when the equity markets are closed. This is a major advantage during overnight news events, earning releases, or geopolitical shocks that moves the market before open. The golden rule: if a position hits your stop loss, exit without hesitation. Protect capital today means more opportunities tomorrow. No single trade is worth overriding your risk rules. If you want to learn more about how I trade options for income, you can check the link below to download your free PDF. All right, traders, trade small, trade safe.